Welcome to Season 4 of the Biz Show, sponsored by InvestQuire. Discover what's next.
Hey,
Hi.
Lisa.
How you doing today?
Lisa, I'm doing well. No
Fantastic.
complaints.
Good. I don't like complainers.
Neither do I. I don't like complainers and I don't like drama.
Yeah,
Drama it just drags me down. It's like, okay, where's the door? There it is. Exit, stage left.
exactly. Run fast.
Yes. Well, thank you guys for joining us in the Biz Show. Lisa and I, we're here to help you guys navigate the pitfalls and the perils of starting a business and running a business, so on and so forth. This, Lisa, is what episode?
Oh my gosh, episode 13, which means we've been at it for 13 weeks now. Season 4. This is our
Yeah.
together. Yes.
4 seasons, episode 13. The first 3 seasons have all been audio on Spotify, iHeartRadio, Pandora, Google, Apple, and a mix of others now. I've seen this on so many platforms, and I didn't put us there, but somehow they find their way there.
They like us that much.
I guess. So 44,000 listeners on the audio platform, and I don't know what, 200 here with maybe 10 subscribers.
Yes, we're trying to get our viewers to come watch us on the YouTube channel, The Biz Show. So if you do have time to not only listen to us on audio, but also switch over to YouTube, we'd love you to subscribe there so we can have our count of viewers start climbing up those charts.
Well, yeah, and so YouTube has a very unique algorithm in regards to how your biz or your channel grows and stuff like that. So the more subscribers, the more listeners, and stuff like that. And by the way, these podcasts that we do are between 30 and 40 minutes of whatever the business topic happens to be. So we try to go in depth as far as we can in a 30-minute time frame. But listen, if we don't get everything and you have questions, you can reach us at investquire.com, or we also have a Facebook page for the Biz Show. You can find us there too. Lisa and I are always happy to help and talk to you about your needs.
Exactly.
So you said this was episode 13. So this is about safe notes, right? This is part of our investor relations series, and we're talking about safe notes. What's a safe note? When should you use it? Well, first of all, it is a mechanism for financial. My mind just went blank on me, but
we're going to dive right in and we're going to teach you all about it, right? So let's dive in.
Yeah, exactly. Yeah, so we are going to dive in. But look, a lot of founders hear the term safe note and assume it's easy for startup money, right? And it kind of is, but it has its challenges, right? Just because it's simple to sign it and get it going doesn't mean it's simple in the long run, right? So on the backs, you got to be careful because the backside can really change things up a lot.
That's true. We don't want you to be in the using them for the wrong application. So safe notes can not only be useful, but they can also create a little confusion and delusion and have the false confidence if the founders do not understand what they're agreeing to. So that's why we say be careful when you choose to use the safe note. This is one of the topics where the legal document may be too short, but the consequences can be very costly and extremely long. So we want to explain this to you on this podcast today so that you can make sure you're using it at the right moment or for the right.
And you said something in there, dilution, right? Dilution. And so that's something, it's not, we'll talk about it in this episode, but just real quickly, just understand this. Your stock can get diluted as you bring more and more investors on. You only got 100% of the stock. And if you own a certain part of it, and then you bring some investors on, well, they're going to want some of that stock. So you're going to have to give some of it up in order for them to invest in your company. That's dilution, right?
Yeah.
So you had 50%, now you got 40%. You bring someone else in, you might have 30%. So your stock starts going down. It gets more critical when you're with companies like we have a company that we're raising $10 million for, and they're in a Series A, their percentage is going to go down, especially if they go to a Series B or C round of funding. They're going to have maybe 5% of ownership in the company left when they're done.
That's right. There's the delusion right there. That's not
Right.
a good if you're the one that came up with the idea in the first place and you're the project owner, you do not want that. So anyway,
Yeah, but that should be all in the terms, right? So just know this: safe notes, they're not magic, right? They are a financing tool. And that's what I was looking for earlier, a financing tool, right?
right.
Um, and like any tool, it works best when used in the right situation. We're going to talk about those situations because it's not good for every single situation.
Right. So what is a safe note? It's actually what, a simple agreement for future equity?
Yeah, simple agreement for future equity. And basically what that is an investor gives the company money now, right now, right? The company does not issue any stock. So what they get instead is a safe note, and instead the investment converts to equity later, normally during their seed or their second round, whatever round that's coming up next. Like most of the time, safe notes are the very first. You're looking basically at angel investors on this stuff, right? So you're looking for somebody that might invest $50,000, maybe up to 250, maybe $500,000 with a safe note, and they're gambling on the company, right? It's not it's not a loan. It's not the traditional loan. It,
Right.
it, it the good news is there's no interest involved in it. So investors and founders really like it because it's basically like a promissory note, if you will, right? There's no taxes involved in it. There's none of those things or interest. There's no maturity date, right? So that's the good thing. With a safe note, you don't need a valuation on the company and say, oh, this company is worth, $2 million.
Mm-hmm.
Nobody knows what it is because you're pre-revenue, so on and so forth, right? So uh, basically, you're delaying that valuation, which can cost a lot of money.
There's pluses and minuses. So we're just trying to point those out to you so that you know when to use the safe note. But a lot of founders are really attracted to safe notes because it's really simple and they're also
Hmm.
a very fast mechanism to use. They're
Yep.
cheaper than the full price equity round and they're less document heavy. So nobody really likes paperwork. And so that gets a little bit scary when you're signing the dotted line. So it's definitely more streamlined. And they're often easier to explain to the early backers in really plain terms, just very simplified.
Yeah.
Investor is betting on the company early on, and the reward comes when later the financing event really sets the value of the company. So a safe note is really a bridge between early belief and the future ownership structure of the company. So it's what you maybe need in that space and time.
Well, yeah, because as a startup, you're complete unknown, right? And nobody really knows if you're going to make it or you're not going to make it. But the investor is going to gamble on you and say, okay, I'll invest whatever and give me a safe note. So let's talk about safe notes, right? So why safe notes have become popular, right? They, some people like them, some don't. We have an investor we work with who detests them. He doesn't want them. But we have many that like them. So safe notes become popular because early stage startups face many problems, right? Specifically, they need capital, right? Number one. But it's too early for a formal valuation because that costs money and they don't have that. And of course, they don't have anything to evaluate, right? They don't have any revenue. They probably don't have a product yet. So what's there to evaluate? I got this desk here. It looks nice. What is it, about $500?
Yeah.
Right?
Right.
Um, and they don't want to take the time or the cost to actually go through that whole funding period. It takes time, right? So
Yeah.
we've talked to many companies in regards to funding, and funding can take up to 18 months
Yeah.
to get the funding, depending on the size and the complexity of the deal.
Yeah.
So traditional equity rounds, well, they need a legal team, right? You're going to have a legal team, valuation, negotiations, board approvals, and complex especially with a young company, a startup who doesn't really know how to handle that.
Yes.
So, but safe notes, that's what they do. They reduce all that friction for them.
Yes, exactly. But it also works well, Barry, when the company is pre-revenue or really early stage revenue, like we mentioned earlier, and the
Hmm.
founders want to close on small checks really quickly as they move along in the process. And the investors do understand the risk that's involved, which is why they're taking this route initially. Both sides expect a larger financing round later on. And so, really, the key point is that safe notes are designed for startups where future financing will gain the momentum as the company is growing. And they're not ideal for every small business. We're not trying to tell you that you have to use a safe note or that when capital is needed. This is just an option.
Yeah, yeah, definitely so. And just I would mention this, right? Keep this in mind. If you're a startup and you don't have anything, it's risk for reward, right? You don't have anything, so the risk is high. That means the equity that investor is going to expect is going to be high too, right? So
Yes.
that's the offset, right? And so that'll be worked out in the term sheet of the safe, and in the safe note. The safe note is the term sheet, but it'll be worked out in there at some point what their equity would turn out to be, a plus probably with some interest involved in that. So let's talk about how they work. So safe notes basically, it usually converts into shares when, as Lisa said earlier, a trigger event happens. What's that trigger event? It's a funding event, right? Whether you've got your safe note, you got $50,000, and now you're looking for pre-seed funding or seed funding, that's when it's going to trigger. So let's say they give you $50,000, and then along comes your pre-seed. Right? With that, you're probably working with a venture capitalist. They're going to drop down $500,000 or so like that. At that point, the evaluation happens on the company, and so that valuation with a safe note, then the dollar amount with that safe note then is basically tied into that evaluation. That's the percentage that they get, plus probably some type of interest. But um, the main things here is this, right? You got to be careful of the dilution because you could really just all of a sudden not own that company anymore if you're not careful. Um, and so the things that you're going to want to look at is the valuation cap, right? The valuation cap, it sets the maximum company valuation used for that conversion. Again, that's going to be based off of whatever that round happens to be. It protects early investors if the company grows quickly. So how does that happen? Well, a company could really kick off and go well, and then the early investors, they invested a little bit of money, but now the company's gone like crazy, and so but they only got that much in, and really now there's all this in here. So there's some verbiage in there that can kind of offset that based off of what happens with the company. The next rounds are normally much higher, right? So you're looking at safe note investors gets a benefit of the lower cap table. And what that means is this. So now say the company's worth $1 million. You came in when it was worth $100,000, but it's proportionate, right? So you get to keep that proportion. Even now it's $1 million. Works out well. Then there are discount rates, right? So the discount rates are for those investors, right? This gives the safe note investor a discount on future shares. So they also get a percentage. Maybe it's 5%, maybe it's 10%, 7%, whatever it is. They get a discount on coming in on that next round of investments, right? So that's they like that. They like that a lot, right? Because that could be a lot of money for them. Um, anyways, these rewards the investors are taking because of the early risk, and that's what you're giving them up to get them in and get them to write that check to you.
Okay, yes. And the next point with
Crazy,
that,
huh?
and it's really important that you're getting the safe note and the terms written as part of it, by a qualified individual. So I know Barry and I could help you with those services, or if you have your attorney, you would definitely want the terms to be reviewed, if not written by somebody that's skilled in that to protect you and to make sure
Yep,
that it's going to be bringing you value as you're moving along with this startup company, if you will. So there's
yep.
a conversion dilution trigger, the safe note doesn't just sit there forever conceptually without any purpose. It usually converts once a specified event triggers or actually happens. And usually the
Yep.
company will raise a qualified financing round in order for that. That is going to be an
For it to
example of,
trigger, yeah.
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 So the fourth point would be the dilution, like we mentioned
Yes.
prior. This is actually part where many founders underestimate. Every safe note can become an equity later. If a founder raises multiple safe notes without modeling them carefully, then dilution could actually stack up and be, a negative. But the ownership can shrink faster than expected. So future investors may question the cap table. So just be aware of that. And then the fifth
Yes.
one, no immediate valuation fighting. That sounds attractive, but it can also hide the reality of the situation. So just be aware of that. You may be postponing a difficult conversation later rather than solving it that you think you're doing by utilizing this. So just know that that could pop up later, and you would want to be fully prepared for that event.
Kicking the can down the road,
Always,
huh?
right? We love to
Yeah.
avoid the potential
Well,
risk, right?
isn't that what
Raising.
our government does all the time? They always just kick the can down the road.
Oh boy, we'll get to it later, right? No.
Sometimes we'll get to it later. Why founders might want to use a safe note, right? So here's your scenario. Well, not, we'll get into the scenarios, but
Yeah.
basically, a safe note can make perfect sense when your company is very early stage, right? The valuation is generally hard to determine. We don't know what this is going to cost. Founders, they need to move quickly, right? They've got something, they got an idea, they got a product, and they got to get it to market. They got to do it quickly, but they need funds to do it. So investors are startup savvy. So make sure that they're going to make sure that you know what you're doing too, right? The amount being raised is modest. It's not millions of dollars. It's not hundreds of thousands of dollars. Mostly in this particular case, it's under $250,000,
Mhm.
probably under $100,000.
Yeah.
But the company does expect to have another round, whether it's an institutional or angel, whether that's going to be a seed round or a Series A, whatever the case might be. So the advantages to it are it's got a fast closing, lower legal cost involved, less negotiations, and number five is the founders can stay focused on execution instead of spending all this time over here in left field with the investors trying to get money. That was one of always my pet peeves in some other companies I ran as a CEO. I was always in investor relations. You know, yeah, I had to run the company and had a responsibility of it, but I also was still the face of the company and had to, talk to investors and stuff like that too. So it took up a lot of time.
Right, right. Well, it could be useful when you're raising from friends or family, or like you mentioned, angel investors, and you can close early. You want to avoid setting your bar too low, evaluation, on your valuation. So don't set it too low too early. Your traction is improving. Your traction is improving if you expect to justify a better valuation later. So in the right case, a safe note buys time, but buying time
Yes.
only helps if the business actually uses that time well. So
Isn't that the case of life?
yes, timing is
Well,
everything.
isn't it always? So when founders might not want to use this and when a safe note is not going to work, basically is a business is not really venture ready, right? So it's an idea. It's written on your business plan is written on a napkin, and you and your buddy got together and you say, hey, let's do this, and that's not the time to go out and try to raise capital, right? You need to really kind of put some structure of the business in place first, right?
Yeah,
There's no clear path of a financing round. So you've not really talked to any investors and them to come back and say, hey, we're not ready now. We like what you're doing. Come back to us in 6 months,
yeah.
right?
Mhm.
We've talked to a few people like that.
The
Um,
timing.
If you don't understand dilution, you need to understand it and then become an expert at it, because that's going to be your Achilles heel on a safe note, right?
Yeah.
Actually, in any investments, is going to be your Achilles heel, but mostly in a safe note, because that can really dilute you fast if you're not careful.
Hmm.
Uh, and if your cap table is already messy, and what that means is you've got, you know, 10, 15 investors, and you don't have a cap table, a spreadsheet or something to know who's invested what, how much, what percentages they get, and stuff like that, that's a mess. And then somebody's got to sit there and figure it all out. Who paid what? What's the percentage and stuff like that? Okay, how much did you totally collect? Right?
Oh, yeah. A
So
lot of
so that's a
at that point.
yeah, exactly. That's a messy cap table. And then the amount raised is large relative to the size of the business. So if you got a small firm with 10 employees and you're expecting to raise $100 million, well, you have a screw loose and you need your head examined, right? Seriously, you're not going to get $100 million. You'll get maybe $10 million, but
Yeah.
so it just needs to be proportionate to the size of your business, right? That's the
Exactly.
thing. If you're running a steady, profitable small business and not building a venture growth, well, then a safe note may be the wrong instrument for you, right? So safe notes are built for companies expecting future equity financing. If you don't have that in place, don't even ask for a safe note. Continue on, talk to investors and find out, ask them what you need. What would it take for you to invest in me,
Hmm. That's
right?
really where you get your answers, right? Don't be afraid to ask that question because you'll get your answer very quickly. And you'll
Yeah,
save yourself a lot of time and agony of trying to figure that missing piece out. So just ask them straight up. I like that.
yeah.
Yeah. So why else would you not want to use a safe note? Well, it could create these following issues. Unclear founder economics. Founders may think, wow, well, we didn't give up equity yet. But economically, they probably did, and they just did not see it or realize it. They were delayed in that process. There could be a lot of confusion around the cap table, like we talked about, multiple safe notes with different caps or different discounts and different dates could be very, very confusing. And that could turn into a mess and a lot of arguments. And especially during the next round, when you're ready for your next round of funding, it could just complicate things and delay things even farther. Your misalignment with investors is really comes into play a lot. You're misaligned. You have the wrong project owner and the wrong investor, and you just don't get along, and you don't have meeting of the minds to put together a successful deal or a successful safe note. And you really probably just need to step away and find somebody else. So some investors understand that safes and some do not. If your expectations are really vague, then these relationships can get fairly strained, and then there's not a lot of confidence in the deal. So when there's no confidence, you're probably not likely to make a safe note executed or even happen. And there's also a sense of false simplicity. A simple document doesn't mean that there's a simple outcome because things do change along the way.
They do change daily. Daily things change, right?
Yes.
So we've talked about a safe note at a 50,000 foot view. Also, you probably heard the term about convertible notes and also equity, priced equity, right? So let's kind of just compare those, right? So first off, a safe note, right, which we've already discussed, but future equity instrument, because there'll be another round and that will dictate what that price turns out to be. Usually there's no interest or taxes on that thing or a mature date. So investors and founders, they love that because guess what? Uncle Sam doesn't have to get involved. You don't have to pay taxes on anything, right? It's easier and faster to do. When we're talking now about a convertible note, what's a convertible note, right? Well, it's actually a investment, and that as it's going to convert from debt. So they're basically going to give you a loan. Say it's $50,000, and it's a convertible note. Now that $50,000 at a certain point is going to convert into equity in the company. So you're never going to pay that money back. It's a convertible note. It becomes equity in the company, right? So debt converts into equity later. Often does include interest. So there's going to be that involved. It does have a maturity date, meaning this is the drop dead date. It comes due, and they're going to now have equity whether you can keep going or not. Uh, but there's more pressure if conversion doesn't happen as planned, right? Because now it converts, they have equity, and you have no money.
Not
They're
a
not
good.
going to be happy about that, right? That's not a good thing. Yeah. And then a priced equity round or just an equity round, pretty simple, right? Shares are sold at agreed upon valuation, right? So you look at the stock market, right? There's the price of Apple and Amazon and Microsoft. Those are the set valuation prices of those things. They're complete and they're transparent. It is what it is. Everybody in the world can see it, right?
Yeah.
There's a lot of legal work involved. There's a lot of negotiations involved in that stuff, and it's very, very, very expensive to get it done because you're going to involve people like Lisa and myself. You're probably going to have CPAs involved. You're going to probably have attorneys involved. You're probably going to have broker dealers involved. So all these legal fees are going out, you know, before you can even sign on the dotted line.
And it's really sad to see a company or a startup trying to, launch their business idea and they've absorbed all of their assets on the expense of attorneys and everything. Like people spend a lot of time preparing instead of just executing and putting themselves out there. And that's like the fine line, which we should probably have a podcast episode about because there's really a fine line on pull the trigger or how much money should you, use of your own resources to get your business started and going.
I'm,
So that was great. How did you,
I'm going to write that down right now, Lisa.
oh, yay. All right. We are live, guys. We are live. This is really happening right now. Okay. So, also, I mean, determining if the right choice is a safe note will depend on the stage of the company, the financial goals that you have, your investor sophistication, and like we mentioned earlier, the urgency of it. So, an unexpected next round or an expected next round will also play a role. And how clear is your valuation? That's really also another key point. The general rule is that safe notes equal speed and flexibility, whereas convertible notes, they equal bridge with debt structure. And the priced round is really the clarity and the permanence that you would require in that note. The founders would need to choose based on the business model, not on the current trend, and also the stage of where you're at.
Yeah, exactly. So again, safe notes are great if you're a startup, right?
Yeah.
And that's where the safe note comes into play. So let me give you an example, right? Here's an example. Let's say a startup is a software platform, right? So currently they have a little bit of a beta product that they're working on, right? It's not completely finished. It's not alpha because they're kind of done coding. It's now beta. It's being tested and refined. Quality assurance is being done to make sure bugs and stuff like that. But you have no revenue yet because it's not in the market. You're still in development stage or at least quality assurance stages on it. You have a strong founder team, right? So your management team, your CEO, your CFO, your COO, your sales vice president or directors, all those stuff come from great pedigrees and stuff like that, right? And you're raising $250,000 from angels. Um, and you've talked to a few probably venture capitalists, and you
Yeah.
do expect a seed round in a year.
Mm,
Okay, great. So a safe note may make sense in this because the valuation is still premature. Legal costs, well, they matter. Um, the raise is relatively small, $250,000, and future pricing event is likely, meaning another round is coming. You've already talked to them, and they've said, yeah, we're interested in it, but come back and when you're at this point.
right. That's right. Well, now let's contrast that with a company scenario that where the safe note does not make sense. So I'm going to cover that. So A company where your profitable niche is like a service business and you have like modest growth and there's no intention of venture fundraising. Say you want about 300,000 to expand your operations, and that company may be better served by debt or bank financing or revenue-based financing because perhaps you already are having revenue. So you also want to structure like a properly equity deal. That is also an option to you. And the reason the safe note would not likely be a suitable choice and a very poor fit is because the company may never have the kind of future financing event that a safe note would expect to have post the
Right.
safe note.
Exactly. Exactly. And that's a great, great scenario, Lisa, really. Um,
Yeah. So hopefully that helps you guys.
yeah.
When,
So how do you decide whether to use one or not? Here's some questions to ask yourself. Are you truly venture style growth? Are you, a growth company?
yep.
Um, and when I say venture style, meaning you're going to be raising venture capital, or whether a venture capital firm or whether it's a private equity firm or a family office or whatever, right? So are you truly that? Um, do you reasonably expect a future priced round, meaning there's another round coming up of funding, right? Because that's going to make a big difference to other investors.
Yes.
How you model dilution under multiple scenarios. You really got to think about that, right? Because one investor is going to want this, another investor is going to want that, and another one's going to want that. And
Yeah.
and once you kind of set one in place, you're kind of stuck in with that model, right? You
Yes.
can't really go and have six different models based off of six different investors.
Right. Exactly.
Um, are investors experienced enough to understand the structure? So there's a key thing, and you and I run into this all the time, Lisa. We come across some very sophisticated investors, and then we come across some investors that are really like, yeah, well, I'll think about, I don't really know, and stuff like this, right? So some are very, they've been in here a long time, they know what they're doing, they know what to expect, they know how the game is played. Others, there's new investors, especially when you get into the angel investor side. An angel investor could be you or me, right? And now we are an accredited investor, and we want to, help a few startups out. So we're going to put some of our money into it. But yet, do we know all the ropes? Maybe, maybe not. And I'm not
Right.
saying you and I in particular. I'm just saying
No,
in general, startups,
general.
right?
Yeah,
Yeah. Um,
exactly.
are you using this for speed or just to avoid a hard conversation, right? Because as we said, a safe note can push that hard conversation and kick the can down the road. And that hard conversation is really with yourself. Is this company really worth it?
That's right.
That that's the main question, right? Is this company worth $100,000 in debt?
Let's face the facts, guys.
Yep, yep,
Um,
exactly.
yeah, so we want you to be successful. So also when considering a safe note, ask yourself, will this create a future cap table problem for you? Like what Barry said, don't create problems later. Let's tackle this from the right angle from the get-go. And also, are the valuation cap and discounts reasonable? That'll help you determine if it's appropriate. And could another financing structure actually just be a better fit for your business model? Like when Barry mentioned, maybe you have a misalignment with your investors or they're not really sure what financing structure to use. It could be that they're not familiar with your niche or your industry or your project specifically. And so you just want to make sure that it's appropriate for your business model. And also, like I mentioned before, have legal counsel review the safe note terms, review any financial structure. You want to put a second set of eyes on that to protect you from having those problems later down the road. And then lastly, do the founders fully understand what happens at the conversion time? So don't sign your financing documents just because they're popular or you may trust the person or whatnot. Just make sure that you have the right people behind you before you sign anything.
Yeah, and that last one, Lisa, is critical, right? So understanding what happens at conversion. What happens, you get diluted. You had 50% and now you don't, depending on what you put in that safe note or any, whether it's a convertible note or anything, what you put in there, that's going to happen. So you might end up somewhere down the road with nothing.
Yeah. Then why are you doing this in the first place, right?
Right, exactly. So let's, we always give you tips and we always give you things to avoid. So tip number one, use safe notes only if your financing path actually supports it, right? So meaning you can see that there is revenue going to start coming in and that you've talked to some other investors and they want to come in, but at a later date when you're a little bit more mature, right?
Yeah.
Model dilution before signing anything, meaning you take a look at that dilution, understand it and know it because it will happen, and you might be crying later on and you can't even cry to the bank because the bank don't want you. You ain't got no money.
About it, exactly.
Keep terms consistent when possible when raising multiple investors, right? It's always best to have one safe note across multiple investors. Um, you actually can have multiple ones, but you can't manage them properly, right? And
Yeah.
expectations get out of whack. It's better to have one solid one across the board. And that might take time because this one investor says, great, I'm in, here's the terms, boom, we go. Next investor says, well, he's got 7%, I want 9%.
Oh, yeah.
Well, no, because that throws the whole, even though there's not an evaluation officially, but it
Yeah.
will throw your cap table and your dilution all out the window.
That's right. And don't confuse delayed dilution with unavoided dilution. So don't,
There's no avoiding.
yeah, it
Yeah.
is what it is, right? That's what I always
Yep.
like to say. And use experienced legal counsel even for a simple instrument like a safe note. Can't stress that enough. Make sure that investors and founders are aligned in their expectations before the money changes hands. Always make sure they're confident about what you're doing.
Are you guys
And
on
then,
the same page?
yeah, and we always give you these pro tips. We like to leave you with something positive, but there's always a way to think about things that you might want to avoid when you're making the decision. So if you're using a safe note because it sounds easier without actually understanding the conversion terms, don't use it. Consult with somebody.
Yeah, exactly. And then two, raising too many separate safe notes with
Yes.
inconsistency, caps and discounts. Stay away from that. It's just a nightmare.
Yeah. Or the third one would be assuming that no maturity date means that there's no urgency. That's a misconception.
That's a misconception because people are going to give you money, but they're going to expect something somewhere down the road, and
Yeah.
not 16 years down the road, but uh,
Yeah. They don't go
probably, yeah,
back and haunt
yeah,
you.
exactly. Using safe notes for business that are unlikely to raise future rounds. Shame on you for doing that, especially if you say that, right? There's a paragraph called safe harbor. And so I've used it many times, and we've used it many times. And basically, that says that anything that I tell you is subject to change,
Yeah.
right? So just because we said something today and this is what it's going to be, it's based off of outside influences and factors that tomorrow could change. We went to war. Prices of milk skyrocketed to $12 a gallon. Who knows, right? But those are things that are unforeseen, and you just can't, adjust for those. So
Yeah.
safe harbor clauses really kind of cover that piece. But shame on you if you're trying to
Yeah.
raise a round and you don't have a future
Yeah.
round behind that
That's
to use that safe note.
yeah. And the last thing is don't ignore the dilution until the next round of financing. That is just like we said, just procrastinating the elephant in the room conversation. You want to be fully prepared on how you're going to deal with that when you do have to face the next round of financing. Know what you're willing to live with and what you're not, and have that ready and available to you, and so that you don't have to be forced into a corner because now you need the next round of financing, and oh my gosh, you're not thinking with a clear head. So just don't ignore that aspect of a
Yes.
safe.
Yeah, definitely, right? So it can be safe notes can be a useful tool, but it's got to be in the right situation, right? And don't substitute it for underlying your capital strategy. Make sure make sure that everything is clear, it's black and white, and that everybody, and the investor and you, are clearly on this same page, in the same chapter and on the same page, right?
on the same dot, on the same line. And this is
Yes.
only the right financing structure should it fit your business model. So always think about your personal business model, your personal goals, your growth path, and your investor relationships, not just what sounds easy and quick. Think about all of those aspects that are meaningful to you.
Yes, this has a way of coming back and nipping you in the backside if you're not careful.
And we don't want that to happen.
We
So
don't.
let's,
That's why we had this podcast today, right? To help
yeah.
get you to understand, give you a little bit of a primer on a safe note.
Yep. We want you to be successful and make a lot of money. So
Please.
until next time.
All right, guys. Well, listen, have a good day. Thank you so much. Go out and make some money.
That's a wrap. Bye. Thank you all for listening to the Biz Show podcast. Subscribe to stay updated and follow Barry and Lisa on Facebook at The Biz Show. Share your comments or suggest specific business topics you'd like to hear. Thank you all for listening. Bye.